Hey folks, Tom Busby here. There's a high degree of risk involved in trading, and past performance is not indicative of future results, but do your due diligence. Now, in my opinion, when I think of the market, there's a couple ways I think of it, but I'm always thinking about strategies with options. And one of the questions that has bugged me for many years is why they have a rule called pattern day trade, because I think it hurts the smaller accounts. That's my opinion. Now, avoiding a day trade when trading option spreads, we dealt with just straight out long calls and straight out long puts. This is a little bit deeper into how to avoid a day trade to keep your account from going in violation. Now, if you review my previous YouTube lesson on avoiding a day trade when trading just a straight long call or put, then watch this one. I think you'll have a full understanding of what I would call the insights to avoid those day trades. The focus of that lesson was avoiding a day trade by turning a long call or put into a call spread or put spread at the end of the day if you wanted to close it out rather than taking a day trade. Now, our discussion of avoiding a day trade, if we begin our trade from an initial entry as an option spread, a little bit more difficult than an outright long call or long put. The key with this avoidance, you can only have opening transactions on day one. You have to remember that rule. That is the insight or the rule you got to know anytime you put an option trades on, unless you're going to have a day trade. So open day, opening transactions only. Now remember, there are only two types of opening transactions in trading. There's a buy to open or a sell to open. The key is it's an opening transaction. Now let's look at some examples to discuss a few of our many choices when trading options. First, let's discuss what we can do if we initially buy an option spread to begin a new trade. Consider we take an initial trade with the following strikes: buying an open $100 call and then selling it to open a 103 call. That's a spread. A net debit of $1 comes out of our account. And let's say that spread at the end of the day is worth $1.50, went our way, but we can't take a day trade. Well, what do? Well, you sell to open an additional 103 call and buy to open an additional 104 call as protection. Let's say we collect 40 cents from doing this, which now lowers our risk, which is what you're always trying to do with options, from $1, the initial outlay, down to 60 cents. Now, if the market goes up overnight, we make more money from the debit spread that we had long, but we lose on that credit spread. If the market goes down overnight, we will lose some of the built-in 50-cent profit from our original 100 to 103 debit spread, but we'll make money on that additional bearish credit spread that we sold. Now, what if the options were not a 1 wide, but only offer a 2.5 wide? It's a little different, but not much. If we open an initial trade, buying a 202.5, selling a 205, we have a long spread. To hedge that trade overnight, you might do the following: sell to open an additional 205 call and buy to open a 207.5 call as protection. The width of the additional credit call spread will determine how much downside protection, upside potential, or risk we may have. Let's leave that discussion for another lesson. Now let's discuss what we do. We initially sell an option spread to begin a new trade. One of my favorite tactics is sell open a 245 put and buy a 244 put with a net credit of 30 cents. I make money if it stays above that 245. However, let's assume the trade goes against us and our put spread is now priced at 45 cents, meaning we are down 15 cents on our original opening trade. We can assume we cannot exit the trade because we cannot take a day trade. What do? Well, in this case, we typically sell a call spread to bring in additional premium, lowering our risk again, trying to bring in the amount we're down on the initial trade. For example, we're talking about you'd sell to open a 248 call, buy to open a 249 call, and have a net credit of 15 cents, which adds to that initial 30 cents equaling the 45 cents it would take to buy that one side back. That would mean we'd have the following. We'd have a short 245 put, long a 244 put, short a 248 call, long a 49 call. In a sense, this is called an iron condor that we now grew into with a total credit received of 45 cents with reduced risk now. Both spreads have strikes that are $1 wide, so doing this by lowering that total risk on the trade, our initial risk was 70 cents because we only got 30 cents. Now our new risk is 55 cents. I like everything I'm hearing as we go into tomorrow. Our goal is to play the middle since we want to stay above the put, but now we also want to stay below the call. Folks, these are just two simple choices we have when trading options to avoid taking day trades. Remember, the key to avoiding a day trade, this is the most important point. The key to avoiding a day trade is we can only have opening transactions on day one of our trade. As I always say, see you on the flip side.